Hi, welcome back. I'm here with Mike Stein, my good friend and local mortgage broker from Fairway Mortgage. And today I wanted to have him here to ask him about the mortgage rates and how the market's going.
Thank you very much for having me. I enjoy being on these calls with you, so I appreciate the opportunity. Mortgage rates certainly are a bit higher now than what people were used to over 2020 and 2021. During COVID, the bar comparison got a little skewed, right? Mortgage rates dipped down into the 2s and low 3s. And now folks see rates around the mid 6s, and they're like, oh my gosh, the rates are so high.
Right.
Historically speaking, it's not dramatically higher, but it certainly does feel much higher than where it was a couple years ago.
Yeah.
Part of the reason for that is
the average over history too is 7%.
Correct, right. But I will say that the main driving force of why the rates did go to 6.5, and they actually peaked over 7 back in October and a few weeks during the beginning of March, but we're back down into the mid 6s now. Even high 5s on some programs, so it has started to improve. The driving force behind it is inflation. Inflation had ticked upward. And initially, the Federal Reserve Board thought that inflation was going to be, they call it transitory, right? It was going to kind of come and go, and it ended up staying. So that drove mortgage rates up. And their sole focus right now is to tame inflation. They want to get inflation back into the 2 to 3% range. That's going to push mortgage rates back down, probably into the 4s and 5s again, right? So I don't think we're ever going to see the 2s again in our lifetime. That was a unique anomaly with
that's my take on it too. Is just it was a fluke, brought to you by something that was totally unforeseen and unpredictable, and hopefully doesn't happen again.
That's right. That's right. Hopefully not during our lifetime anyway.
Yeah.
But if we could get back into the 4s, I think that would be a huge win.
Right.
But some people say, well, gosh, should I wait to buy until rates come back down? Well, the problem that we have now is there's a lack of inventory. We need more homes to sell. And there's more buyers than what we have with homes. So properties that are in great shape, you're seeing multiple offers. We're seeing anywhere from 4 to 15 offers on a property that's in good shape. The difficulty with that is home values are going to keep going up because of lack of inventory. And so if you're waiting for rates to come down, your values are going up. And all of a sudden, now you're paying more for the property later. The benefit of buying as soon as you find the right property, and once you do that, buy it at whatever the current rate is. Don't buy based on rate. Buy what you can afford comfortably in that market. And if rates come down, it's very inexpensive to refinance the property to a lower interest rate later on.
Right.
But you've already got the property before it kept going up in value.
Yeah, because property does just sort of rise every year. There really haven't been any substantial drops other than the recession in 2008, and that was just based on the housing market, whereas now the only reason why we're having any change in the market is because of interest rates. It's not a problem with the market itself.
So, if I could maybe elaborate on that. Maybe every week I think someone tells me, oh my gosh, this is like a housing bubble like 2008. The dynamics behind this market are dramatically different, right? In 2008, for starters, you had the highest level of inventory and the highest level of new construction home starts in history. So you were flooding the market with an inventory level that didn't have the buying power to absorb it, right? That's indicative of a bubble.
Right
now, if you look at the inventory, we're at a 50-year low nationwide. We just don't have enough inventory. So that is not indicative of a bubble.
Right.
You couple that with the fact that in 2008, there were a lot of mortgage products that were, they were called exotic loans, but you had the interest-only loans and the option arms that let you pay at 1%, but the loan accrued at 7%. There's a lot of creative financing that happened back then that allowed people to buy homes that they maybe shouldn't have been buying.
Right, yeah.
And now...
Yeah, I personally was trying to buy at that time, and I was not qualified. But I got, under contract on 3 different homes, and certainly, so I saw like a lot of that,
Yeah. There's definitely difference now that it is a full document. We're not doing the no-doc loans, the stated income. Starting to come back in the market, actually. You're starting to see like advertisements for those, but they're not mainstream. Most people aren't doing those right now. That's a much more solid market today than it was in 2008. So they're polar opposites.
Yeah, and that's what I had to say to clarify too. I was qualified. They were qualifying me, but not because I really could afford the mortgage payments. So I know how that
So you're right. There were several situations that we witnessed where people were being approved for mortgage payments that they had no ability to qualify. So I didn't do those loans, but there were companies that just specialized in that type of financing. And the whole thought was, you buy it today, and just if you can't make the payment, sell it for a profit in 6 months, and that was the market until it wasn't. And then everybody, got in trouble.
Yeah, but these buyers that have been competing over homes over the last couple of years are fully qualified to stringent standards that they hadn't been at that time. So it's completely different.
Everything is being fully documented now. Even back in 2005, 6, 7, I mean, even Fannie Mae and Freddie Mac had a standard, what they called a full document loan. But if you had over a 720 credit score, you put 10% or more down, they just assumed you weren't lying. So now that ended up being a bad situation. So now we do have programs where we can validate information remotely through things like the work number or income validation sources where the borrower may not give us a pay stub, but we have still validated that income. So we make sure that they are fully qualified to buy. It's not like we're just turning our heads saying, oh, I hope they really make that.
Well, and that's amazing because then you almost don't have to pressure them as much to get their documents together. But you can still.
That's exactly right. It's much easier now. A lot less paperwork is required than it used to be. But overall, I'm actually quite positive on the market over the next 3 to 5 years. We're expecting, the housing values to only increase. If you look at the average first-time home buyer is 33 years old. If you look at the birth rates, go back 33 years ago, the next 3 to 5 years, it only continues to trickle upward. So that is just more first-time buyers flooding the market nationwide, and we still don't see the inventory to support it. So that's going to continue to perpetuate this supply and demand problem. So there's quite a few. And lastly, there are, even though we don't recommend it, there are quite a few people that are sitting on the sidelines waiting to buy until rates come down. Well, what happens then, right? If rates come down, you just
the whole thing all over again.
So it's a weird situation that I do highly encourage people to take advantage of the opportunity to buy a home now.
Because it is a slightly lower price potentially. We see numbers drop a little bit. There's less competition on some homes. So if you can get into a house now and you can afford the payment, you know that down the road you can refinance.
Yeah, I would say that the increase in rate has impacted comfort level, not true affordability. Most clients that I'm talking to, they see the payment that results in a higher payment. While they might be very easily qualified for that payment, it's outside of their comfort zone. So when people say the increase in rates impacted affordability, it impacted comfort level. There are a few people that I've talked to that did price them out of the market, and they have to wait. But what I'm finding more often than not is it's a comfort level thing that people have to warm their mind.
Yeah, it's just different now. You're gonna maybe afford a different home.
That's right. So if they stretch their comfort level a little bit, and then hopefully when rates come back down, as we expect they will, you can refinance and lower that payment and be in a more comfortable space. There's no guarantee that the rates come down. All the stats we're looking at kind of indicate that. But maybe this Fed's not successful at lowering inflation and rates stay high. That's always a risk. So whenever I'm telling people, hey, buy now, refinance later, I always got to caveat that with this is the game plan, but it's not a guarantee.
Which is why you have to feel comfortable with the payment that you're going to be making. Maybe not comfortable, but you have to know you can do it. And then hope to be able to refinance. We hope that the rates come down, but but that's why you should be comfortable with payments.
Yeah, I wouldn't recommend anyone to get into a situation where they don't feel like they can continue to save for the future, continue to contribute to 401k, right? Do the things that they're doing.
Yeah, you don't want to plan like I could do this for 6 months or 2 years.
That's right. That's right.
And then you know that it's going to fall apart after you get through your savings.
Exactly. Right. Yeah. So I am very positive on the market. I think the housing values, at least locally, we're blessed in this area, Northern Virginia, DC, Maryland. We have a very high government concentration, have a high corporate concentration, and a high military concentration. We just have constantly people moving in and out all the time, which really, when people look at the news and they hear these nationwide stats, it's a little different in our local market,
Yeah.
right? So it's really hard to decipher
Well,
what
likewise, our prices didn't go up as much as they did nationwide. So, you know, a lot of markets, or the average nationwide was like 19%.
Right.
That went up between 2019 and 2020. Ours only went up 5 or 8%, you know, depending on where you were.
Right.
You know, so if they go down now by 5%, that's not really all that major to, you know.
If you're looking to buy a home to live in, I'm not really too focused on trying to time the market, right? You're buying it to live in and provide a home for your family. It's really not the time to think about what do I think real estate's going to do over the next. If you're buying an investment property, maybe that's a little different. You put a different thought process on the local market, but you know, even an investment property in this current market, I still wouldn't be opposed to that.
Right, and no matter what, whenever you buy it, you're building equity, you know. So if you buy it now at this rate, or if you wait and the rates don't even go down, you buy it later at the same rate, you just lost, you know, any sort of equity growth that you could have had. So, you know, it's always better to just sort of do it, you know.
Absolutely.
Yeah.
That's right. So it's a matter of just understanding your comfort levels, and that's part of the consultation call that we go through with every client. We figure out their comfort level with monthly payment and comfort level with money out of pocket, and we back into a price that works for them. So we don't attack it from what's the max I can get you qualified for. We focus on comfort level, making sure we start there, and hopefully they can find the type of property and the geography that fits. Sometimes they find they have to either bump up on price or bump out on geography. Something might have to happen for them to find a perfect match, but it all starts with a call to figure out financing rate.
I did 3 mortgages with Mike myself, so I can say that, you know, what he just described there is great, because you don't feel like you're pressured or you have this limit. You kind of know that he's sort of helping you aim for the payment you want to make, you know, and it's not, you know, just a, you can afford X sort of deal. So.
In fact, I've never even tackle that question unless somebody actually asks me. And in most cases, when they ask me and I tell them, the response is, "Oh my gosh, I would never go to that point," right? Which is great, because in early 2000s it was the opposite. Somebody would say, "Is that all you're qualifying?" I was hoping to go much higher. So I think people have gotten more focused on making smart financial decisions. They're more conservative than they used to be. I think that's another reason why I don't think we're getting our housing values getting out of hand, because the mortgages that are going on the books now are quite solid and will perform very well.
If you want to reach out to Mike or me, you can reach out to either of us first. Either one of us can get you started. So his information will be in the description below. Thank you so much, Mike.
Thank you so much for having me. This has been great. Thank you so much.
And thank you all for watching.